ask you a simple question. Are you actually being paid for giving up liquidity? Because that is the premise behind what investors call illiquidity premium. The idea is straightforward, really. If you lock up your capital for 5 or 7 or 10 years, you should earn a higher return than you would in a liquid investment like stocks or ETFs, for example. Here is where I want to challenge that assumption. Just because an investment is illiquid does not mean it is better based on the higher premium. And more importantly, it does not mean you're being compensated for that lack of liquidity. Let me explain. The illiquidity premium only exists under certain conditions. First, when there are fewer buyers. Second, when capital is constrained. And third, when investors demand higher returns to justify locking up their money. But look at what has happened over the last several years in the market, especially real estate. We have seen an influx of capital into private real estate, family offices, private syndication. What happens when too much capital chases the same deals? Returns compress, cap rates compress, and suddenly that so-called illiquidity premium starts to disappear. In some cases, investors are actually accepting lower returns while still taking on illiquidity risk. That is a dangerous combination. Now, compare that to the public markets. Public equities offer daily liquidity, full transparency, and in many cases, comparable or even better long term returns. The question becomes, why give up liquidity if you're not being properly compensated? Now, this does not mean that private real estate is a bad investment. Not at all. Far from it. But the value is not just in illiquidity, it is in the structure, the tax advantages, the ability to value add and improve the asset, the opportunity to create such value through executions, not simply by locking up your capital. Here is how I would think about it as an investor. Do not assume that there is an illiquidity premium. Actually, test for it. Ask yourself, am I being compensated appropriately for the lack of liquidity, or am I accepting illiquidity without the return to justify it? Once you give up liquidity, you also give up optionality, and optionality has value, especially in uncertain markets. So, the next time you review a deal, do not just focus on projected returns. Focus on whether those returns actually compensate you for the risks that you're taking, including the risk that you cannot exit when you want to. Because protecting the downside starts with asking the right questions upfront.